Welcome to BOSS 217 Business Finance 1. In this module, we will take you through the principles of finance and how this relates to corporate environment with specific interest for new business students. And the idea is to give them the background that allow them to go through the effectiveness of having to do quantitative analysis within corporate environment. Without further ado, I'll go to the next slide. Just to introduce myself, that this course actually is a 3-module course focusing on developing the basics for corporate finance within the corporate environment. And in our academic session 2021-2022, my name is Dr. Bello Lawal with the Business Department, and I will be taking you through this module for this semester. A bit of background about myself. I actually have a PhD in Finance and Risk Management from Glasgow University with MBA from ABU, and also undergraduate bachelor degree in Business Administration from University of Abuja. With the respect to professional qualifications, I've got a lot of certifications which you can see on the board, as well as belonging to different professional bodies, with my research interest focusing on corporate governance, risk management, compliance, and energy market valuation, amongst others. This slide with respect to learning outcome is designed to equip new students with the basics, and therefore we will be looking at the principles and the fundamentals of finance within the rhythm of the beginners, and focusing on those elementary topics and elementary themes that govern the corporate finance. So here we'll be looking at things like time value of money, the market valuations, cost of capital, among others, and also investment analysis, as well as capital budgeting decisions, to say a few of them. And at the end of the course, we expect that the students will have the operational level knowledge of how to carry out quantitative analysis and actually make an informed decision with the basic knowledge of financial quantitative techniques. The course profile focus on the things that we will be covering, and specifically we have modules that are conceptual based, from the basic principles of finance, the role of financial manager, the time value of money, introduction to capital budgeting and investment decisions, valuation method and cost of capital, short-term financing and activity measures, financing capital structures and element of risk, and as well as financial market and institution. When you look at this module, they are designed to provide a background into the corporate finance and how financial management activities work within a corporate institutions. Just for reference and the future expansion of knowledge from the student point of view, you will like to reference some of these recommended texts, like The Fundamental of Financial Management by Eugene, and also we have Strategic Financial Management and Strategic Financial Management by Wisting, amongst others. With respect to the assessment, this course will be divided into 2 assessment points. The first assessment will cover on homework assignments that allowed you to actually do this thing independently, carry out the quantitative analysis and calculation on your own, and also we will be having a CA that will be CPT based, and then you have the final exam. The CA will carry about 30% of the total score, and then your final exam will be 70%. As you can imagine, you are expected to attend, and the attendance actually have 70% as a minimum condition for you to be able to be eligible for the final exams. Then we'll go to the first unit, the basic principles of finance. And finance, it's a multifaceted knowledge base that covers every aspect of an institution and organization. To this end, we have different definitions that people try to attempt to define what corporate or finance is actually about. But irrespective of the definition you want to adopt within the context upon which you are defining finance, there are basic fundamentals that you can see in those definitions. like circulation of monies, things like granting of credit. That's what the business do, finance business do, investment, and also provision of banking facility. So finance in general cover the issue related to money, either mobilizing of the money from the surplus environment to a deficit point, or facilitating and providing auxiliary services that provides organization and investors, give them that platform to be able to transact in financial activities. Then the core areas. We have three fundamental core areas in finance. One focuses on the financial management, which is basically the issue of mobilizing resources from the point that have significant sufficiency to a point that have a deficit and need for the money. This need for the money means that people who have investment opportunity but they don't have the required capital to actually embark on those projects. This is an angle that finance actually focuses on. Another one is the capital market. Capital market provide a platform where marketable securities and all sorts of securities are actually traded. Within the concept of capital market, finance focuses on things like efficiency of the capital market itself, how the securities actually are reflective of the prices that are being given in terms of the market fundamentals and microeconomic fundamentals. Then you also have the investment angle of finance that focuses on ability not only to do visibility studies, but to be able to attach the monetary incentives to those visibility studies that allow people to make an informed decision on whether to go into a project or to abandon project or to wait until such a time that the fundamentals become more robust or more bullish. The next slide talk about how finance are related, and we have multiple disciplines that actually relate to finance. One of those disciplines is the economics. Most of the mathematical computation and analysis you are doing are mostly econometric driven within the financial context, and you also have those figures that you actually have to compute are data usually extracted from the accounting information, and therefore finance is not only related to economics, but they are also related to accounting because they believe and also rely on the data from the accounting presentation to analyze some of those data. And then the last one is the mathematics and statistics. Most of the formulas you can come across in corporate finance, financial management, strategic finance, they are always driven from statistical analysis or from the mathematical model that have been developed over the years and then cross-fertilized into the business management. Then the next slide will look at the goals of finance. Why do you have finance? Why do we talk about finance in business? We talk about finance because firms have goals, and these goals are driven by the orientation that they have regarding the marketplace. Marketplace in the sense that people operate businesses to make profit. It therefore means that organizations or firms must have goals. They must have objectives that they want to achieve in order to create that value and have something to show to shareholders that indeed the business are working and they are profitable as intended. And therefore, across modern corporations, goals objective of finance focuses on four classical areas. One is the profit maximization. You can't do business without ability to deliver profit. The venture capitalists, the creditors, the government, all stakeholders are interested on what you make from the business because they participate in the sharing of those upsides. And therefore, some organizations may adopt the profit maximization orientations, while some organizations look at the long term. Profit maximizations have been deduced to be a short-term orientation. Organizations that are focused over the years on profit alone seems not to survive difficult times or hard times, just like the one we have faced in recent times. Like since last year, we've been hit by heavy pandemic, a lot of businesses have collapsed, and this is an indication that if you are profit-oriented, you wouldn't have survived the out of this pandemic because the market is completely shut down. But organizations may have a goal of wealth maximization, meaning looking at the long run. ability to keep afloat, be building the capital, be building the wealth of the organization slowly over time. And then you can also adopt a goal of value. Value means that every single thing that organization does are actually dependent on what value they can create for the shareholders. And in modern organizations and in modern corporations, things have drastically changed. Value, profit, wealth are usually not sufficient. The slogan now is the profit is in the cost of doing business. And therefore, the last one talked about cost leadership, cost optimization. Organization must be able to demonstrate efficiency and effectiveness in their production processes, in their internal control systems, in their internal procedure and processes, so that people don't subvert the effort of creating those value. And in the process, you will be able to save significant amount of money that puts you at a vantage point of your product's competitiveness. If your competitors can produce the same product at 15 naira, for instance, and yours is coming into the market at 17 naira, I don't need to tell you that people or consumer that are rational will likely go for those substitutes that give them less prices. So therefore, in the temporary business world, cost, profit is in the cost. And if your profit is in the cost, it therefore means that you have to build efficiency in your production processes, efficiency in your internal processes, efficiency in your organizational structure that allow you to enter into the market with your product at a very lower possible cost of production and remain competitive. Key finance decisions. Every organizations are faced with strategic finance decisions. These decisions are across the value chain. Value chain in the sense that from the starting point of the business to the point at which it becomes mature, you want to fertilize and also go into these businesses, up to the time that you deliver value from those businesses and how those values will be shared. These are significant value chain in every business. Therefore, strategic decisions have to be taken across each of these spectrums of value chain. The first has to talk, we talk about investment decision. If you have to go into business, there is the need for you to make an investment decision. Investment decision here is based on capital budgeting decisions. In other words, are this business able to give you the streams of benefits, or promise you at least the stream of benefits that allows you to recoup back the initial investment and also be able to make something upside above that? That is an investment decision. And we have got a lot of techniques in finance that actually allowed you to x-ray and carry out this quantitative analysis of investment decisions. We have those that we call discounting techniques and non-discounting techniques. It depends on which environment you operate and also the kind of context upon which you are making those investment decisions. Then the next one is, how do you raise funds? Corporations over the years have come to realize that it is not sufficient for you to use the owners or business owners' funds. Some organizations, some companies are capital intensive, and the way they do business are capital intensive. So you may want to have the combination of the owner's fund and also other people's fund. So this takes us to the concept of capital structure. What is the proportion of equity you want to have, and also the proportion of debt you want to have in your capital structure? These are decisions that have to be made. And then the last one, the second to the last ones per se, is the dividend decision. You have make an investment decision, you have got the finance using both equity and debt, then you have actually carried out the business, and then you have made profit. How do you share those profits? Do you share everything to the shareholders and then come back and raise funds again? Or do you have to have a retained earning system that allow you to share some part of the profit and have some part of them returned into the organization? And the last, but the most dangerous decision that needs to be made is the liquidity decision. Liquidity focus on ability of the organization to meet its short-term obligation and still remain in business within the short time. What are these short-term obligations? Things like the employee salaries. Are you able to pay them? Are you able to pay for your utilities? Are you able to pay for the office administration and other auxiliary services that fell due within 12 months? If you can be able to meet all those obligations that are short-term oriented, the presumption will be that you will not be able to survive within 12 months. And that is why it is a strategic decision that has to be taken by the financial managers. So we have 4 of them: the investment decisions, the financing decisions, the dividend decisions, and then the liquidity decision. Now we have the fundamental principle of finance. There are 6 fundamental principles that govern financing at cross-board, whether it is at advanced level or at a basic level, and also at intermediate or beginners level, as we are doing in BOSS 217. Now, money has time value. In other words, what we mean is the money you spend today, the purchasing power of that money will change if you have to spend the same amount of money tomorrow or next year. So the value of 200 naira or 2 million naira or 2 billion naira in 2020 is different from the value of 2 billion naira in 2021, because time has passed, and the impact of time also have the inflation implication. It has interest implication. It also have devaluation principle and also other implications that actually dampen or increase or enhance the value of the currency that you have. And it is a simple arithmetic. Assuming before the pandemic, the exchange rate between naira and dollar was, let's say, 350, now it's around 400 and something. Which therefore means if you have 1 million naira in your bank, the volume of dollar that 1 million naira will have bought in 2020 would be different from the value it's going to buy today, because it has to buy less, given the fact that your naira has lost some value. And then the next one is, returns are usually expected from investments that pose a lot of risk. The higher the risk you are taking in an investment, the higher the promise of return. And therefore, if you have investment opportunities that are less risky, the orientation or presumption is that you will have likely going to have less return from those investments. And also, if you want to now look into the return and the risk elements, another one critical strategy is your diversification principle. If you diversify your investment opportunities into different sectors, the likelihood is you are going to reduce the risk. Risk in the sense that you are not putting your egg in one basket. And that is one fundamental principle of finance. Don't put your egg in one basket. If you have to invest in different businesses, then do that. Don't invest in the same businesses across different locations, because it is still one single business. If anything have to happen to the macroeconomic fundamentals, it will affect your business. Then you also have the issue of market efficiency. How efficient is the capital market? Are people able to do insider trading? How mature is your capital market? This is one of the key principles that you need to also align with. And the presumption in the finance is capital markets are presumed to be efficient until proven otherwise. Yeah, and then the last, and second to the last one, is the difference or conflict of objective. People who hold the business in a contemporary business world don't normally engage in day-to-day administration of those business. There is what we call principles of separation of ownership and control, whereby the shareholders are not the managers of the organization. So this is a fundamental principle, and therefore, because the manager's orientation is different from the owner's orientation, you will have objectives that actually differ. In most times, you have conflict of interest between the two parties, which create an agency problem. Then the last one is the fact that reputation matters. If you say it is yellow in business, in finance, make sure it is yellow. A situation whereby you have to lie or misrepresentation of fact, it is not an ideal way of running finances. Then the next slide talk about the good characteristics of good financial decisions. What are those parameters? What are those imperatives you can see? A good financial decision must be sustainable. It must be distinctive. It can't be things that people can easily copy. And it should provide you with competitive edge and advantage. And last but not the least, it should be profitable. Because at the end of the day, businesses are meant to make profit. Then Unit 2 would look at briefly the roles of financial manager. These are the people entrusted with the function of managing the finances of organization. And we said they have a lot of things to do. They are responsible for significant investment and financing decision. What are the kind of investment or projects should the company actually pursue? And what should be the capital structure? How much percentage should be the owner's fund? And how much of that should be the one that you have to borrow from the outside, which is a debt? So, financial manager actually will determine the ideal capital structure for the firm. And then also the fact that the financial managers actually stand between the operation and the financial market itself. They become like an intermediate focal point within the organization if you have to participate in the broader financial market. This slide talks about the responsibility of financial manager and advisors. People who actually carry out the function of financial manager have a lot of multifaceted functions or roles that they play. Role from investment decision, role from strategic dividend decision, role from strategic liquidity decision, and also roles from the solvency decision that organizations have to make in order to continue to operate as a going concern. Now, within those roles, we have another delineation of those individuals that carry out more specifically those financial functions. And you have the treasuries, who are people that actually manage the raw cash and also the physical cash that organizations have, whether in the bank or at hand. And then you also have the finance controllers who actually prepare the financial statement, demonstrated the fact that organization is carrying out its business and also recording the transactions in line with the accounting principles. And then the last one is the chief financial officer, who have the overall oversight responsibility for treasury and also the financial controls. In modern organization, chief financial officer is liable for any activities that treasury department or financial controllers have actually done in representation of the organization. This slide talks about the finance and agency problem. And in finance, because the money are being spent on behalf of the shareholders are individuals that bought the share into a corporation. They are not there in the day-to-day administration. It therefore creates a principal-agency relationship. The principal are the shareholders, while the agents are the managers. And therefore, because the shareholders or the principals are not always there when they manage this organization, the presumption is that the financial manager, in taking those financing decisions, may become self-interested. To this end, there are areas of conflict. And in the down part of the slide, we talk about those two areas that conflict are likely going to come. Conflict between the manager and the shareholders. Shareholders may want more dividend, but the financial manager may want a more retained earnings so that they can explore more business opportunities in future years. The next one would be the stockholders and debtors conflicts. While the debtors will also want more of their debt being paid and also the principal and the cost of them, the shareholders will want to retain more earnings. But what are the essential skills that a financial manager needs to have? You need to have quantitative ability to calculate, quantitative skills, analytical skill to be able to make sense of those numbers. It's not only sufficient for you to be able to calculate, you should also be able to make sense of those numbers. You should have ability to communicate and make presentation that makes sense. Attention to details, because you are dealing with finances. And then the last one, you should have an ability that allows you to organize the organization skills, because you will be faced with a lot of document, a lot of paper, a lot of transactions. Your organizational skills is very apt. And then the last part of this course series will be the time value of money. The time value of money talk about how the value of money changes over time. So the time value of money actually talks about how the value of money change over time. And this is a concept that tries to depict that over time, when the time passes, the value of money changes. If you have to invest 20 in 2021, the presumption is whatever amount you are investing in 2021, the value of that amount will change in 2022 because of the risk and also the orientation of inflation that has to do with that. Then within the concept here, we have two things. Your ability to calculate the time value of money on the present and also on the future terms. This slide talks about the present and future value of money. And for the present value, all you need to do is to be able to identify the discounting position for the present value and also for the future value. And this depicts a clear example. The present value of 200,000 to be received in 3 years, discounted at 6%, allows you to look into the standard time value of table, and that will allow you to go under the period 3, and whatever factor, discounting factor is, you times that with the sum that is being invested or is promised to receive over 3 years, and that gives you what you have as the present value of that money. This money, I hope you know, is supposed to be a money that should have been received in 2024, but the value of that money today is showing you about 168. That is a clear distinction of how the value of money change. Someone promising you 200,000 in 2024, the value of that the value of that 200,000 today is only 168. And then you also have future. If you have to also meet an obligation in futures, like 200,000 the same in 4 years over 10% interest rate, you can see here that discounting the future, looking at what the future will be of this current value, will shows you the impact of how it graduates from 200,000 to 292,000 over time. Then the last part of this course talk about the annuity. Annuity is a series of payments, and series of payments actually allows you to have a sinking fund. For instance, if you have a debt, if you have issued a debt that will be maturing over time, like 10 years, 20 years, what you need to have is to provide a sinking fund that you will use to build up these funds, capital, to the level that when the maturity date comes, you don't need to scramble. You will just have to make good your obligations. And then there are two types of an annuity. We have an ordinary annuity, which is an annuity in arrears, and also we have annuity due, which is an annuity in advance. And the difference between the two is the fact that an annual, the ordinary annuity or annuity in arrears are usually at the end of each period. That is when the payments are made. But for an annuity due or annuity in advance, payments are made at the beginning. And if payments are made at the beginning, it therefore means that it has implication of both discounting factor as well as the interest rate for both two of them. So this last slide talk about how these calculations are made, and for the fact that an ordinary annuity have the same basic principle like the present value calculation. But for future value, what you need to do is to provide for that discounting and non discounting. If you have a future value of an annuity, the discounting factor implication is different from when you have a present value of an annuity. And this is the end of the part 1, and see you again in the part 2 for the detailed part of this course. Thank you.